Thank you. Thank you, everybody, and good morning. Alan, thank you for the warm introduction, and Scott for the warm welcome. I appreciate everybody coming out this morning at this, it really is night. It's incredibly early. And I hope you don't mind if I clutch my coffee while I talk with you. And I hope that what we can have is some conversation, which is what I much prefer to having me talk at you. I have a little bit of background on the program and the 18 months. I guess it's been has it been more than a year? You're 14 months in, is that right? Jillian, where are you? You graduate in May?
Graduate in May.
You all graduate in May. So you've been together for a long time now. Yes, and you are all mid-career. You've come from other things. You've not right. Some of you are. You're graduates. All right. Well, I was going to observe that as accomplished as you all are, you still do what students do, which is sit, in most cases, as far away from the professor as possible. So when we get to conversation, I will be coming to you. You cannot hide. We did the Socratic method at Harvard Law School, and I remember it. So I noticed your eyes will slide away, but I'm still going to ask you, questions. I was asked to say a little bit about my current gig, which is at Bain Capital. As Alan was saying, we founded a new private equity fund, a middle market fund, that is about investing in lower middle market companies, all in North America, for both financial return and measurable social or environmental impact. I'm going to tell you a little bit about how I got interested in this and what we are doing, and then I will stop and we can, yes.
Can I ask what the name of the fund is?
It's called Bain Capital Double Impact.
Thank you.
Yep. It's closed right now, but I'll let you know when we reopen for Fund 2. We would be welcome to we would welcome your investments. So I got interested in so-called impact investing in my old job as governor of Massachusetts, and I was introduced to a fellow named Sir Ronald Cohen, a very successful regular way private equity investor in the UK, who had then moved on to create something called social impact bonds. I don't know if any of you are aware of this tool. And the notion is that private capital comes in alongside government. Sometimes they're described as pay-for-success contracts. Comes in alongside government to innovate, to try something new. And Sir Ronald was coming through the states explaining this concept to various sitting mayors and governors when I was in office, and I got jazzed about it for a couple of reasons. One, because for all of the interest I think we all have in innovation in public policy, and indeed I would say innovation is as important in public policy as it is in today's global economy. To have successful innovation, you have to raise your tolerance for failure. And politics punishes failure. So you get less innovation than you might like because the consequences of it not going beautifully the first time will cost political people their jobs or careers. I had the great advantage, having run for one thing, that I could focus on the job rather than my career, and so the notion of having a laboratory where you could try some new things was pretty exciting. And the notion is pretty simple. There's a design of a project or an initiative that would save public money by trying to solve a problem a different way. In our case, we did the first two around individual chronic homelessness and at-risk youth recidivism. And you use this strategy to prove out whether there's a better way to get better results, first and foremost, and to reduce costs to the public. And if it works, the bondholders get paid from the savings, not all of the savings, but a portion of the savings. And then you have a proof point which you can bring to the legislature to think about more radical or scaled change. It's early days, but the early feedback has been encouraging. Sir Ronald then went on to create something called Bridges Ventures, which is an early stage impact fund, same thesis, which is market level or style returns, financial returns with measurable impact. And I met him again not long before I left office, and I said, how long have you been at this now? He said, 4 or 5 years. And I said, have you got any exits? And he said, yeah. And I said, well, what sort of returns are you getting? And he said, well, if our conventional funds are yielding 18, 19 net, we're getting 17, 18 from our impact funds. And I said, what? And he said, well, yeah, that's the point. He said, I'm trying to demonstrate that you don't have to trade return for impact. So all my antenna went up. I left office not entirely sure what I wanted to do, and investigating impact investing in the States then, so this is early 2015, and I think it is fair to say that the field is more mature in Europe than it is here in the States. And so as I was looking around, I didn't see a lot of opportunities that made sense for me as someone who is not a conventional and experienced private equity investor. I have some pals at Bain Capital who had offered to sort of be coaches for me, give me feedback as I was thinking about my next things, and I went to see a couple of them about something I had settled on in New York. And I remember one of them, Steve Pagliuca, reacted to the description of what I was thinking about doing. And he said, that sounds great. He said, but you don't really sound passionate about that. What are you really passionate about? And I started to talk about impact investing, and he sat back and said, I can't believe you brought that up. And I said, why? He said, because we've been trying to figure out as a firm how to get into that space for some while now. Because our LPs, our investors from Europe, have been asking for these products, as you might imagine. So he said, why don't you come in and help us figure it out? And so I joined the firm in April of 2015. It was actually kind of funny because it took us about 2 days to work out the terms and 2 weeks to figure out how to announce it, for reasons that some of you can imagine. I spent about a year with borrowed talent from other parts of the firm, working out the business plan, really trying to understand what the white space was for a firm like ours in this space in North America, having decided that that would be the geographic footprint for our first fund, and also what types of companies were likely to yield enough deal flow for us to prove out what it is we were trying to do. And so we decided that we would start small, a $250 million fund, which to me is a lot of money. At Bain Capital, it's quaint. It's charming. You know what I mean. But again, the notion was nail the model and scale from there. We elected to do, as I said, lower middle market investing, but later stage, because most of the impact investing in the States is venture and other early stage. And what we were finding is that lots of entrepreneurs who are mission driven and were growing fast could attract capital, but that the next investor was more interested in the financial dimension and less so the mission, which is to say, as one entrepreneur put it, we sell on, but then we sell out. And what we're interested in is scaling the whole thing, the whole idea. We decided that we would invest along 3 broad thematic verticals: sustainability, health and wellness, and what we're calling community building. So by sustainability, we're interested in sustainable consumer goods, in alternative energy and energy efficiency, water efficiency, that kind of thing. By health and wellness, we're interested in affordable health care, including behavioral health. We're interested in nutrition and wellness generally. Also in that category, ed tech companies whose products or services are about closing achievement gaps or skills gaps, which is the latter in particular, a huge problem, challenge in this country. And then community building is more of a place-based strategy. So it's companies that are intentional about creating jobs and catalyzing economic activity in places of chronic underemployment. And I can give you examples of each of these. We've done 4 investments so far. We closed on $390 million, and it was still, the demand was still coming, but we said, let's stop. We decided to up the cap a little bit because we were seeing enough opportunities where the check size warranted for control stakes was a little bigger than what we had originally anticipated. We have a team now of 15 full-time investors. Most of them transfers from other Bain Capital funds. And I was very intentional about gathering around me people who had investment experience. And we underwrite to exactly the same financial standards as our large cap fund, which will be on the minds of many of you. And we're measuring impact at an entry level and as we go against goals that we set for our portfolio companies, and also as a fund. So it's early days. We closed the fund a year ago this spring, yes. And as I said, we've done 4 deals. I hope we will sign another today. Please wish us luck. Yeah, we're off to the races. Is that enough?
That's great.
To get it going? Is that generally descriptive? Questions, comments, advice?
Can you
Yeah.
talk a little bit about the companies that you guys have found that
Yeah. So the first one we did was a company called Impact Fitness, which is actually now a Planet Fitness franchise. And they target, it's a company in Michigan and northern Indiana, which has targeted communities where there is a high incidence of obesity, type 2 diabetes, heart disease, and so on. Health issues related to fitness. And they've made the model work in those places unlike anybody else. So if you think of the conventional economics of a gym, it's charge as much as possible and hope nobody comes, right? As you're all nodding, because right. This is the inverse. It's $10 a month, and we're driving utilization, and we are beginning to measure the number of times, for example, a week that you get your heart rate up. We're sharing that with the health insurers, obviously with consent, and health insurers will subsidize the rates. 40% cash-on-cash return is very, very profitable, very profitable. And we've made one add-on acquisition of another territory, and we'll add another probably by the end of March now. By the end of March, it's really, really going well. And we're sort of the test kitchen for the Planet Fitness company, because as a company, I wouldn't say saturated, but they're in a bunch of places where there's large concentrations of population. They haven't cracked this code, and we have. So it's a very valuable franchise within that system. The second is a company that is, I would describe as inherently impactful. It's the largest company of its kind in Texas. Who's my friend from Texas? Where are you? You, right. I'm sorry. That was you. Sorry. It's a company in Houston and largely in Houston and Dallas called Living Earth. And they divert organic waste, yard clippings and stuff that the road crews clean up from the highways, from landfills where it would otherwise decompose and create CO2 to compost. And they sell it back as composted soil or mulch. Ridiculously profitable. And we've added we just bought a company in Tennessee to expand that, and we're looking to basically roll up a bunch of similar companies or establish this practice across the Southeast, and mostly the Southeast because of the length of the growing season. We got a little bit of setback from the hurricane, but the recovery was pretty quick, and I think, as folks start to repair their grounds from the damage, now that the growing season comes, we'll come back strong. The third company is, I won't go into all of the companies in great detail, but the third company is a sustainable small restaurant chain, very much about the sustainability of the supply chain and the wellness of the food served, and that's a trend nationally that we're investing behind, and its returns are already pretty impressive. So, yeah. Is that enough of a flavor?
Yeah.
Yeah.
So this would qualify as an alternative investment, so is this for qualified investors, or can the public?
No, qualified investors. Right. Minimum to come in was $5 million. It's conventional private equity, same fees and all that stuff.
Yeah.
Yeah.
Okay.
Yeah. Excuse me.
So, when you say conventional, 2 and 20?
Yeah, I guess I'm not supposed to say, but
No, that's okay.
look at me.
So my name is Maggie. My background, I'm a 2004 graduate of the program, and spent 10 years at the Kauffman Foundation, 4 years on the Kauffman Fellows program.
Yeah.
Um,
You guys are doing a lot in this space now. I mean, Kaufman
I'm
is.
not with,
Okay.
Most recently was with an organization based in San Francisco called Portfolio.
Yeah.
That builds micro VC funds
Okay.
to engage and activate female accredited investors.
Okay.
So I stood up three small funds for them, and now have come back and focused on Kansas City, and I'm putting together a $5 million seed capital fund
Mm-hmm.
for the Enterprise Center at Johnson County.
Mm-hmm.
And anyway, my questions were more around average size investment, geographic restrictions.
Yep. So we are writing, figure $10 to $40 million equity checks, $5 to $15 million EBITDA companies. We would go smaller. We want to be cash flow positive. We would invest in a company that had a line of sight to cash flow positive in 18 months, let's say, but that was growing really fast. We prefer a control position. In one case, we have not done that, but we have enough influence. But there's control, and then there's control. It's not so much we have to have 51% or more, but there has to be alignment with what it is we're trying to build and where we're trying to go, including on the measurement piece. And yeah, I think. And you asked about geographic focus. The first fund is North America. And that was not without a lot of debate, because there is a lot of unmet need, and actually a lot of activity in emerging markets. But it's a new team, and we're active. We want to be active partners and not just board meeting partners, if you know what I mean. And we thought the team should be together because it's new. So we're all, or almost all of us, in Boston, and we thought we should be within easy reach of the team because we're all together. So we decided we'd stick to North America for Fund 1.
And so mostly Series C, Series D investments?
Yeah, we're later stage.
Way much later.
Yeah. It could, I mean, think of buyout, but in almost every case, actually, I take that back. In every case, the founder has rolled, all or some, and is stuck with us. So you know what it's like. You're investing in people. No, I get it. But but similarly, you're investing in the team,
Right,
in the management team. So we're not going in to run the companies, but to help.
Super interesting.
Yeah, it's fun. And we can talk about anything. We don't have to talk about impact investing. Yes, ma'am. I should have asked you all to say your name and tell me a little bit about you as you did, Margaret.
When you're looking at funds, do you weigh the considerations of political implications? I'm not sure exactly how to ask. But
Yeah.
It seems like there could be some political implications on what you choose to invest.
I don't know. I don't think so. We get asked questions like, well, would you invest in clean coal, for example, if there is such a thing? And we haven't confronted that. We haven't said categorically no, if that's the kind of thing you're getting at. We have. I think. I don't know if it's. Maybe this is small p political. It's really important to me that there be impact integrity, and that it's not just marketing. There's you could, as I say there, I described Living Earth as a company that's inherently impactful. It's in their business model. They don't think of themselves as an impact enterprise or mission enterprise, but what they are doing is inherently impactful. That's a pretty easy call. There are companies, and maybe in a way, Impact Fitness is like this, where it's more managed impact. There's something we are trying to do to make it impactful. I described when we were shopping the fund to investors my hypothetical widget company. You know, nothing inherently impactful about widgets. And let's say that widget company has an old and out-of-date manufacturing facility. And we say, we're going to own that widget company, and we're going to cause that widget company to build a LEED certified manufacturing facility, and we're going to put it in the south side of Chicago, where I grew up, as a way to bring people from the margins of the economy into the mainstream, as Method Soap did, by the way. And I would argue that is a wildly impactful investment. It's intentional, right? You know what you're trying to accomplish and whom you're trying to impact, and you can measure it. So we're very open to that kind of investment. I don't know if you know this company, Shinola. Do you know anybody know Shinola? You do, yeah. Shinola they make watches and leather goods and so on. It's they established themselves in downtown Detroit on purpose because they wanted to be a part of the revival of downtown Detroit. And they've had a huge impact in the community around Wayne State, if you know that area at all, as a result of that. Yeah.
Chris Longley, class of 2013, Merrill Lynch. So do you have a sub-thematic for ESG, environmental, social governance, like that these companies you're looking at, you know, you have two companies, but one has a female CEO. Do you guys have any weighting towards that as another impact investing side?
So far, we haven't had to make that choice, and I think so. There's what we use as the kind of foundational tool is something called the GEARS survey, which comes out of B Lab. You follow B corporations at all? Beneficial corporations. Any of you know what I'm talking about? It's actually a pretty hot trend where you can either register or certify as a B corporation in, I think, 40 states now. And a B corporation means that you are, by law or certification, taking account of multiple stakeholders, shareholders being one, but also community stakeholders, employees, and so on. And the GEARS survey captures the ESG features. So we're rating. That's our, as I say, that's our sort of going in measure, and we get our baseline measure using that. So I guess I would say ESG is incorporated. You get a higher score if you, yeah.
Second question: are you running for president?
Not today.
Are you interested in running for governor in non-Massachusetts states like Kansas or Missouri?
You know, it's funny. Any other questions? I've run for one thing. You know, I spent most of my life in the private sector. I was an executive at Coca-Cola and at Texaco, and in private practice and private law practice. Before that, I had one public gig as head of the Civil Rights Division in the Clinton administration. But I hadn't run for office before governor in Massachusetts, where I've lived for most of the last 45 years. And I ran in part because a very, very bad habit I've seen in business, which is this quarter-to-quarter management, the short-termism, I think sometimes at the risk of the long-term interests of the enterprise. I think that bad habit has crept into the way we govern in this country. We govern from election cycle to election cycle, or news cycle to news cycle, and not generation to generation. And I wanted to see whether it was possible to govern that way, and frankly to get elected with that notion that we weren't going to, that the promises I was trying to deliver on wouldn't be promises necessarily that we would deliver on in 4 or 8 years time. I should say we don't have term limits I have a term limit named Diane, who said 2 terms and that's it, which is part of my answer to Alan when he asked me in 2016 about. But I will say that we had expected challenges, like there's never enough money for all the stuff you want to do, and never enough flexibility. Back to the innovation point, and then unexpected things like a global economic collapse or a terrorist attack at the Boston Marathon. And I am proud of the fact that when we left, we were first in the nation in student achievement, in economic entrepreneurialism, in veteran services, energy efficiency, healthcare coverage. 99% of our residents are insured. We had the highest bond rating in the history of the Commonwealth. Our budgets were responsible, 25-year employment high. We got a lot of good stuff done. We didn't get it all right. Joan's here from Massachusetts, so I know you're going to call me out. We didn't get it all right, but we got in a kind of a groove about how we can actually make some hard decisions that are not about us as much as they are about our grandkids. And I'm proud of that. So as I think about the future, I'm really focused on this right now. It's important. It's important to me. It's important to the firm, and it's important to me if I do go back into politics that this be real and succeed. And I'm thinking about 2020, but it's so hard to think about that it's easier to think about this. Yes, ma'am.
As somebody who's kind of straddled a bunch of different industries,
Mm-hmm.
Government, how do you drive the conversation? How do we as business people help drive that conversation away from the quarter-to-quarter outlook and more towards generational?
Yeah, so did you see Larry Fink's letter, his investor's letter? You know Larry Fink?
No.
He's the head of BlackRock, which is, a behemoth of a...
I do know BlackRock.
Yeah. So he sent an investor's letter, which got a lot of news this spring, to, I think it was the investor's letter, about how to think in fresh ways about about long-term value. And that long-term value has to include environmental and social impacts of the kind we've been talking about today. And by the way, I think that is factually true. That's not just a nice thing. In an age of ubiquitous information, to me, it's unrealistic to think you can manage to the financial bottom line all alone. Because if you mess up environmentally or socially, it will come back to bite your financial bottom line. And basically what he's saying is there has to be a way to think about American capitalism today that is broader and is more, it takes account of all of the consequences and essentially said, and that is what he's going to be looking for as the largest investor, maybe the largest investor in the world. There's a guy named Mark, CEO of Aetna. Can't remember his last name. Yes. Yes, thank you. This will happen to you one day. They're merging with CVS now, and Mark is leaving at the end of the merger. And we were on the phone, and he told me he was at some fancy New York thing with a bunch of other captains of industry, and everybody in black tie. And he got up to give his remarks, and he said, "We're all sitting here clueless," said he. And the place went quiet, and he said, because capitalism is under attack. And he went on to talk about how millennials, an overused term, but millennials emerged from college having done everything right in the middle of the economic collapse. And it has shaken their confidence in capitalism. And they are insisting on a broader notion of what value means. And that his point was, I don't go this far, but his point was, if you don't figure out a broader definition of value, and measure it, by the way, that capitalism is in jeopardy. like I say, I don't go quite that far yet, but there's something to that. And you know, when we went to see Kaufman and other foundations, the foundations are feeling enormous pressure to be thinking about how to use not just the mission-related investments, not just the program side, but the endowment side, to invest alongside their values. And I think it's pretty exciting stuff.
Some are doing really, like Red Herring, is it Red Herring Foundation? Someone has totally aligned their.
Heron Foundation, yes,
Their investment.
100%,
Yeah, it's
right.
really interesting. I mean, it'll be good to see how that plays out.
Yeah.
Because it could prove the model.
Yes.
I'm Christine Murray. I work for the Greater Kansas City Chamber of Commerce here. And we did a leadership exchange trip to Boston this year. And one of the things that was so interesting, so I'm going to kind of combine the government and the Bain Capital question together, but there's so much innovation. And culturally, even like the DOT was talking about how do you do things differently. You don't just look at 50-year planning.
Right.
How do you, for a cultural perspective, whether it's entrepreneurship, which I also work on, how do you get people to start thinking differently? Is that just something that's in the water there? How do you get people to start thinking, like, this is just because we've always done something this way, we shouldn't just keep doing it this way, whether it's from a government perspective or finding new investors and getting them to think about investing differently or ROI differently.
Yeah.
How do you, was there an evolution in cultural change, or is that just something that was part of the DNA there?
I think it's probably a combination of both, but it doesn't mean it is or needs to be unique to Boston or Massachusetts. I mean, we have some advantages in an increasingly knowledge-based global economy, because there are 300 colleges, universities, research institutions, teaching hospitals within a 45-minute drive of downtown Boston. It's an incredible concentration of brain power. But we do not have, or we didn't have very well developed, the collaborative gene. So folks, you know, at MIT did their thing, but they didn't talk to folks at Harvard or at MGH or what have you. And we tried to do a bunch of things that kind of mashed communities together. So we had something called a life sciences initiative, because we had all the tools for the biotech industry, and we had a good biotech industry, but what we hadn't done is concentrate on how to strengthen it and grow it as a job creation mechanism, because we had all these, sort of natural resources. And I would make the point, we should invest in education in Massachusetts the same way, Texas invests in the extraction industry, or Iowa invests in corn. It's our natural resource. But I got hammered by bunches of people who said, government shouldn't be picking winners or losers. And I get that point, because I'd always make the point, we're not picking losers. But the legislature and the business community and the science community and the medical community came together. They didn't normally come together. And we tried something. We invested, it was $1 billion over 10 years. I think we've invested about $500 million. That has generated $3 or $4 billion in private investment, created thousands of jobs. It was one of a handful of industries that lifted us out of recession faster than most states. We'd been on an education journey for a long time, but we had the same debates, tiresome debates, between the district schools and the charters, and the city and the suburbs, and the conversations around education sort of theorists and scholars, and the business community about what the purpose of education was, and are we preparing employees or are we preparing citizens? And it's like, come on. We got all these folks together, and
For us, like, I wasn't surprised to see the educational institutions were innovative, but I think it was more of your traditional institutions that seemed to be very innovative, and the number of kids who are in pre-K, and it's just sort of that thinking forward, and it was,
we just keep trying stuff. And this is to the point I was making earlier about your willingness to fail. I mean, it's for me, it was easier because, as I said, it wasn't my It wasn't my career. So I could focus on the job.
So, Governor,
Yeah, excuse me.
so I've spent a lot of time in this space for about 10, 12 years, and what you described that you're investing in at Bain now looks a lot like European social enterprise, right? So they're businesses that have that natural double bottom line. But what about, part of the reason they can operate in Europe is the welfare state's so much bigger, right? So there are a lot of areas that aren't being served by the private sector there because the government's serving it. Well, here we don't have as big of a welfare state, and so you still have significant areas of need in communities where the private sector, in the form of nonprofits traditionally, or some for-profits,
Yep.
are coming in that aren't going to have great revenue streams.
Yep.
Right. You actually started out talking about social impact bonds. I mean, those aren't industries that typically have big revenue streams. The savings is in the cost savings.
Exactly.
So, is there an appetite at Bain? Do you see a future with what you're doing at Bain, where you will start maybe tackling what we would call some of the more wicked problems also that kind of fall in this market failure area of social problems? When you think of like housing issues, and like you grew up in the South Side of Chicago, right? And housing's always been one of those big issues, and the South Side was famous with the projects.
Right.
down there.
Yeah.
I mean, so very long, convoluted question, but the idea of, do you see this moving to some more of those complicated systemic issues that can be solved even for companies even for ideas that would be low profit ideas or limited profit ideas?
For us, no.
Okay.
And I should be clear. That doesn't mean that it won't happen in the space or under the rubric of impact investing. I don't think any one model needs to be thought of as exclusive of all others. You know, we are trying to demonstrate at scale that you don't have to trade return for impact, because as we demonstrate that, I think it presents some pretty important questions for investing generally. But there's still room for social impact bonds. There's still room for the many investors who are willing to take a concessionary return, or just to get their capital back. There's a whole spectrum. There's room for that. I will say, there is, and this sort of to the innovation question, there's a model that I'm really interested in that I haven't actually seen in real life, but that was described to me by someone around the housing or real estate development. We looked at real estate, we decided not to do it, and in particular affordable housing, because it didn't meet our return profile, and it rarely does.
Yeah.
But there's a developer I met who talked about this pattern. He said, now, do you know Boston at all? You know Roxbury? So think Roxbury is a poorer neighborhood in Boston. It's, Boston is tight and small, and so you can walk to everything. But few people walk to Boston. There's been very little development in Roxbury for lots of old, tarnished reasons. And he said, you know what? If I go to Roxbury today and I want to put up let us say, 14-story building. Roxbury's mostly low. He said the neighborhood will flip, and he said, suppose I want to have retail on the first floor. I'm going to have offices on the next 2 floors. I'm going to have mixed income apartments, some market, some affordable. And on floors 13 and 14, I'm going to have luxury condominiums. And the reason I'm going to have luxury condominiums, can you imagine this, is because there's nothing else, and the views are stunning, right? Back over the city and out over the harbor. And he said the community will be inflamed. And they will say, you are going to drive up property values so that our rents are going to go nuts, and we can't live here, right? And we've all seen this play out. And what happens? The city comes in and referees a compromise, and the city says, okay, you have to take off your top 2 floors, and you have to make a payment to the, maybe build a little park and make a payment to the neighborhood association, and then you can build it. And he said, now suppose the economics work at 12 stories 2. And you go back and say, I still want story 13 and 14. And I will take the value of that delta and give it to the community as equity in the property. So that in some formula, geographic or the community group is a trust or something like that. He said that the reason he's thinking about this is because what happens is, in these kinds of developments, is we end up debating how to preserve pockets of poverty for poor people rather than how to lift people out of poverty. So suppose they have a stake in the thing. By the way, we're dealing with this right now with the Obama Foundation Center in Chicago.
I just saw that last night.
Yeah, same point I've been making there. Suppose we create a way for people, yes, there's going to continue to be pressure on rents, but that owner might actually be able to buy that building from the value of the equity in that project. It's a very different way of thinking about an investment of that kind in a community like that, and I'm looking for how to try that. And we can't quite do it within our fund, but we just added a real estate fund, so we might be able to do it in combination with them. Yeah, sorry. Is this the shy side of the room over here? The questions are...
When you go to school at Kaufman, you come out with the answer to everything is go in and create jobs and create wealth for communities, right? And that's kind of it's beaten in. If you stay there long enough, it becomes a part of you. And what's interesting coming back into the ecosystem in Kansas City after being out of it for 10 years is how much it's developed. When I went to work in the late 90s at Kaufman, no one had ever heard of venture capital. When I tried to say, I work on the Kaufman Fellows Program, there was one VC firm here in Kansas City, and it no longer exists. What's interesting though coming back in is the ecosystem has really become quite sophisticated, and we've got a lot of interesting things going on. One of the things that's cool about Boston, I connected with a woman at Mass Ventures.
Yeah.
Which is so this seed fund that we're building is designed to be an evergreen fund.
Right.
Capitalized maybe with a little bit of civic money, but capitalized almost entirely by donations. Really trying to prove to the community. We don't have that appetite yet for the really early stage investing. And trying to kind of prove to the community that you can do good, that you can invest early and still see some return. Mass Street Ventures, it's a 40-year-old evergreen fund that's returned $96 million in and of itself.
Started by the Commonwealth of Massachusetts.
Yeah.
Right.
It's real, the way it was, capitalized is really interesting.
Yeah.
And I think it's such an interesting time in venture because there are some really, what you're doing on that kind of at that later stage is so interesting, but so is what's happening at the earlier stages. Ohio, with what the state of Ohio's done with the frontier and the money going into different kinds of models to really.
There's a lot of power in public-private partnerships.
And there's my question for you: what do you think about?
There's a lot of power in it. This is another way to think about answering your question. We created something called Mass Challenge, which is an incubator, business incubator. We put in $5 million of state money as a sort of an anchor grant, and then private investors put in matched it and exceeded it, I think, by a factor of 4, and that was 10 years ago now, in the worst of the recession. It's the largest business incubator in the world today, with operations in Massachusetts, in Israel, in England, in Mexico, soon in Austin. And it's again about creating this culture, and it takes no stake, which I think is one of the reasons it's grown so fast. Very competitive. There have been a couple of unicorns that have come out of it in that time. But back to creating this culture of trying things. Let's try a bunch of stuff. Don't throw money at it, because it's like in the Life Sciences Initiative. It's scientists who make the decisions about where those investments should go. These are venture folks, venture experts and entrepreneurs who make the decisions about Mass Challenge, not folks who don't have that expertise in government. But government has its role to play, and that's what we try to do.
Gonna make this actually our last question.
Okay,
So
I'll take one for the
since
team.
it's that-
Okay.
So
From
my
the
name
shy
is Kim
side.
Feltz,
Hi,
yeah.
Kim.
I graduated in 2016 and with John Deere. And my question is, you talked about sustainability, health and wellness, and community building. And one of the things you talked about was closing the skill gaps. And I was wondering if you could expound upon that a
Yeah,
little more, just
yeah.
from a manufacturing standpoint. Costs are rising because we can't find skilled workers.
No kidding,
So
yeah.
I'm just trying to understand that.
Yeah, so if I answer your question well enough, can I get a discount on a tractor? Yeah, you can't? I'm shopping for a tractor. So in the midst of the recession, we're a smallish state. In the midst of the recession, we had, I think I'm right, 170,000 people looking for work and 125,000 vacancies, right? And what the employers were telling us is what you just said. They can't find the people with the skills they need for the jobs they have. And we have I don't think it's just us. I think it's true of many states, and it's true nationally that the training money, and there's a lot of training money in government in various buckets, but we have a kind of a train and pray or a train and hope thing. You train people in some skill and hope that they will find a job, rather than connecting the job to the necessary skill set and then a way for an individual or a couple of individuals to come in, get that skill set, and then train, and then transfer onto that job. There's a clever term we had for it, but I can't remember now. But we enlisted the community colleges to help us with that, to try to get at that skills gap. And because what we were finding is that a lot of those employers needed more than a high school diploma, but not necessarily a college degree. It might be a certificate in some discipline that was pertinent to that particular job. And that's right, learn and earn, that's what it was called, learn and earn. And so we were having employers say, listen, I need, a dozen engineers, and they have to have this skill set, and here's a curriculum that helps us. And they would, together with us, screen the applicants. Folks would come in and get, at low or no cost, a certificate, and then go right into that job. And in many cases, we're doing internships in that job while they were completing the certificate. The companies we're interested in, there's one company in particular that we're focused on that has an online vehicle to get at this. And they have a large online education presence today at the high school and college level. And we think that this is there's an application to the skills gap, regionally specific. Same kind of thing. Talk to the employers, find out what they need, what's that skill set, develop with them that curriculum, and make it accessible and affordable without debt to people who need those opportunities. Yeah. Does that get at it?
Yeah.
Yeah. Still no discount?
We'll dive later.
Okay.
Yeah, help me
Good.
thank the government.
Thank you, everybody.